a physical gold price is going to emerge. So from this point onwards, all global fiat currencies to some degree would be partly gold backed. And the central banks with the highest gold backing as a percentage of currencies issued would relatively be the strongest currency. A higher gold price is versus the dollar, and it would turn all fiat currencies. It's going to, it would suit central banks to have a higher price. This would actually be the most equitable pushback, or indeed an alignment with Glazev's outlined BRICS plus partly gold-backed currency. It all seems to fit together.
Gold's price climbed in 2023, up as much as 9% in April. As of the end of June, the price is up around 4% yearly, around $1,920 per ounce. The rise has been attributed to rising interest rates, stock market volatility, and instability in the banking sector. Andrew Maguire believes that a significant change regarding the price of physical gold is on the horizon. He suggests that in the future there could be a situation where global fiat currencies become partly gold-backed, with central banks holding varying amounts of gold to back their issued currencies. This shift could lead to a higher gold price than the dollar and other currencies. Maguire agrees that more and more people are using gold as a safe choice instead of treasuries to protect themselves from risks involving other parties. Historically, gold has been sought after as a safe haven compared to other assets like stocks or real estate. That's because gold retains its value and liquidity even during economic downturns. He suggests that the Federal Reserve, Fed, must adapt to this changing landscape or face the risk of the dollar and bonds losing their value against gold. Maguire highlights that Basel III compliance in the COMEX market is set to be enforced by the end of 2023. This action could create a domino effect, prompting other central banks to do the same, ultimately driving up the value of gold globally. Maguire indicates that the trigger point for this shift could be around a gold price of $2,000. Once the central banks start revaluing gold, the demand for physical gold would surge, pushing its price even higher. Central banks worldwide added a record amount of gold to their reserves through the first half of 2023. Net central bank gold purchases totaled 387 tons through the first half of the year, according to data compiled by the World Gold Council. Now let's watch excerpts from Andrew Maguire's interview with Kinesis Money. Be sure to watch the entire video and consider subscribing to our channel. Remember to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
Gold has become a competitor for those seeking really an alternative to high counterparty risk treasuries. The Fed will have to adapt, or the dollar and bonds will reach a globally driven inflection point where, relative to gold, treasuries and the dollar debasement risk will accelerate. Well, every well-connected liquidity provider and first-tier bank we speak to assess full Basel III COMEX market compliance will be forced by the end of the 2023 trading. So the question is, where does it leave the Fed? Well, there's only one equitable backdoor other than a global nuclear war. With first-tier gold threatening to increasingly undermine US treasuries, the time will come where the Fed's only backdoor out of the box they've painted themselves into will be to revalue treasury gold from $42 to market. So every other central bank has a gold revaluation account and would equally be forced to pull the trigger, creating a tsunami of demand. Now, could Glazev's gold-backed BRICS currency, or could it be a German Bundesbank triggering a gold revaluation first, triggering every other bank to do the same? It's ultimately just a question of when, not if, this happens. Whenever the trigger point, whatever the trigger point is, liquidity providers figure somewhere close to $2,000. And once the central bank gold revaluation is triggered, the rest will be forced to follow. And the aggregated globally revalued gold price would immediately drive the offer to sell physical gold much higher. In other words, I'm not selling it to you at this price. Let's look at the most recent example, shall we? I mean, given that first-tier gold now competes as an asset class against first-tier treasuries, which following the unexpected US rating downgrade, treasuries were being heavily sold off. It was spiking the yields higher. Concurrent elephant-sized footprints were evidenced selling leveraged COMEX gold futures, clearly demonstrating they were being intervened into when gold should have been rising. Now, the panicked coordinated Fed Treasury official intervention, and we'll explain why this really revealed a very weak flank for them shortly. What it did was evidence officials aggressively naked short selling gold futures, not bid pulling, naked short selling gold futures to inversely fund pumping up the dollar. But given that the sheer scale of this paper supply, despite officials' best efforts to actually naked short sell COMEX gold in favor of propping up the dollar, off grid, outside the casino, that is, competing but unleveraged physical demand is partly offsetting a good degree of really this enormous wall of naked short supply, but not before large central banks spot Basel III compliant orders at spot 1950 were triggered. Now, the large physical bullion outflow is overhanging the wall of paper selling, and this huge wall of paper selling, but it's paper. And when momentum is lost in the paper market, very similar to when the Fed interventions receded or had to recede back in November 2022, a physical price will have to be paid. And not all of this will be able to be offset against the split in the spec category, the speculator category, and contained inside the casino. This is the point we're trying to make. It can't all be settled. This is a bad decision.
Maguire emphasizes that gold is being used like fire insurance to protect against risks, even in paper form. This trend leads to a growing group of speculators using paper gold to hedge their investments. The value of paper gold is directly tied to the price of physical gold, making it an attractive alternative for investors seeking exposure to gold without the logistical challenges associated with owning and storing them. These speculators typically operate within regulated markets like the COMEX and are restricted from trading in over-the-counter physical markets. Recent events in the financial landscape further highlight the significance of gold as a risk mitigator. For instance, when credit rating agency Fitch downgraded the U.S. from AAA to AA+, it sent shockwaves through the market. Fitch had first flagged the possibility of a downgrade in May, then maintained that position in June after the debt ceiling crisis was resolved, saying it intended to finalize the review in the third quarter of this year. Maguire believes that this event prompted coordinated official interventions involving authorities actively intervening in foreign exchange markets, including gold and silver, to counteract the anticipated impact on the risk market. Let's get back to the interview.
Even paper gold is beginning to evidence gold being employed really for what it says on the box, which is fire insurance against risk assets, which increasingly also means actually US treasuries. And that's going to be a subject we look at in a minute. So bottom line, this means an ever larger group of speculators will emulate what we're seeing in the real physical markets, namely these COMEX-centric speculators that are contained inside the casino, forced to stay inside the casino because they're banned from trading the over-the-counter physical markets. Obviously, you can buy physical, but you can't trade the over-the-counter markets, which are physical. So what they're doing is the specs inside the casino are holding these paper gold hedges, and this is the split group, into situations such as we're just witnessing. When the market woke up, in particular, what we see was when the market woke up to Fitch blindsiding the Fed and Treasury Secretary Yellen, downgrading the US from AAA to AA+, and then it spooked the risk market. So, gold really doing what it should do on the box. However, following the surprise Fitch US downgrade last week, which should have been very bullish for gold versus the dollar and treasuries, obviously, coordinated official interventions immediately pushed back against the downgrade, evidencing officials aggressively intervening in the foreign exchange dollar crosses, all of them, which of course includes gold and silver. Officials actually admit to intervening in the foreign exchange markets. But in a situation like this, which of course includes gold and silver, in a situation like this, really counterintuitive action to what should have been happening. And while we expected to see some continued short-term official pushbacks against this US downgrade, if that wasn't enough, Moody's followed through, downgrading 10 US small and mid-sized banks with an indication that the larger banks, yes, the big guys, that downgrades will follow for the big guys. Now, this drew in some fresh Fed-driven interventions, jumping into to prop the dollar up. However, these downgrades, what they've largely resulted from is because of the pace of higher rates, which under the official line of rates higher for longer, which we see the Fed officials talking about, or many, it means that officials are walking a tight rate tightening, really, tightrope, with particular concern over the small banks holding actually over 80% of the underwater high-risk commercial real estate sector loans. Now, we talked about this before. This is the next bank shoe to drop, and it undoubtedly has the Fed's attention, especially as there is the pace of interest rate rises that caused the problem in the first place. So to understand exactly what we're currently evidencing into what is undoubtedly official interventions, which explains exactly the counterintuitive action we're seeing, the US Fitch downgrade from AAA to AA+, it roiled the dollar crosses immediately, spiking rates higher, and with over $1 trillion in US debt that has to be sold in the third quarter to finance US government borrowings, we've evidenced a coordinated official intervention to prop up the dollar against the foreign exchange crosses, which again include foreign exchange gold.
As global currencies become partly backed by gold, a shift could lead to higher gold prices relative to various currencies. What do you think about the possible changes in gold prices and the idea of currencies being partly backed by gold? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.